Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about JD Health International Inc. Annual Report. JD Health International Inc. offers a wide range of businesses and services through its online healthcare platform in China. The company provides various medical consultation and referral services, including health checkups, genetic testing, and beauty care. It also offers home care services such as wound care, blood tests, post-operative care, and medical escort. In addition to these services, JD Health International Inc. provides online medical insurance payment services, smart healthcare solutions, and digital health products. The company also operates offline examination centers that offer convenient and professional healthcare services. Furthermore, it offers traditional Chinese medicine, TCM, wellness, and orthopedic services. The company's product offerings include pharmaceutical and healthcare products through direct sales and online marketplace businesses. It also provides medical devices such as smart monitoring and respiratory therapy devices, senior-oriented medical devices, and home medical device setup and support services. Additionally, JD Health International Inc. offers rapid testing products and operates on-demand retail businesses. JD Health International Inc.'s services are not limited to healthcare alone. It also provides online marketing services to advertisers and online shopping and hospital services. The company serves pharmaceutical and healthcare product companies and has a strong presence in China, with its headquarters located in Beijing. JD Health International Inc. market capitalization of $147 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that JD Health International Inc. holds a significant advantage in their industry. JD Health International Inc. trades at a similar price-to-earnings ratio of 24 times and a higher price-to-book ratio of 2.11 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 22% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. Net income and profit margins show significant improvement. The company's net income has experienced a notable increase over the past year. According to the extracted summaries, net income rose from RMB 13.3 billion to RMB 18.2 billion, representing a 37.1% growth. This upward trend continued into the next period, with net income increasing from RMB 4,157,014 in 2024 to RMB 5,367,109 in 2025. A closer examination of profit margins reveals that several key metrics have improved. The gross profit margin has increased from 22.9% to 24.8%, indicating a more efficient cost structure. Additionally, general and administrative expenses, as a percentage of revenue, decreased from 2.4% to 1.6%, suggesting successful cost reduction efforts. The stability of fulfillment expenses and selling and marketing expenses, as a percentage of revenue at 10.4% and 5.2%, respectively, further supports the notion that operational improvements have contributed to the company's improved financial performance. While the exact reasons for these changes are not explicitly stated, it is likely that cost reduction efforts and or operational enhancements have played a significant role in driving the increase in net income and profit margins. The company's financial performance indicates a significant improvement in its operating cash flow. Comparison of the 2 years shows that the company generated 8,841,561 RMB in operating cash flow for the year ended December 31, 2025, which is a substantial increase from the previous year's 3,359,628 RMB. This upward trend suggests that the company has successfully managed its operations to generate more cash, indicating a positive shift in its financial health. The increase in operating cash flow can be attributed to various factors such as improved efficiency, cost reduction, and effective management of working capital. As a result, the company is now generating sufficient cash to meet its operational needs, which is a crucial indicator of its long-term sustainability. The company's financial performance reveals some notable changes in its debt level and interest expenses. Firstly, the interest expenses have increased significantly, rising from RMB 8,194 in 2024 to RMB 11,098 in 2025. This increase is evident on both page 101 and page 155 of the extracted summaries. Regarding the company's debt level, there are mixed signals. On one hand, pages 50-17 and 117 suggest that there has been no significant change in the debt level. However, other sections provide a different picture. For instance, page 146 indicates an increase in financial liabilities from RMB 14,254,200 to RMB 18,660,748. Additionally, page 147 notes that the company's debt level has increased due to floating rate cash and cash equivalents and restricted cash exposure. However, there is a contradictory statement on page 162, which states that the total debt, liabilities, decreased from RMB 18,806 to RMB 20,425. This discrepancy suggests that the company's debt level may be more complex than initially thought, with different aspects of its financial situation showing varying trends. Management is optimistic about JD Health's future prospects, emphasizing its commitment to a supply chain-centric strategy. The company aims to strengthen its supply chain advantages and broaden its healthcare service offerings to become the most trusted health management company. To achieve this goal, JD Health plans to implement an omnichannel model, diversify its product offerings, and optimize operational efficiency. Additionally, the company will foster an open ecosystem by strengthening partnerships with global medical device brands and expanding its influence in specialized medical fields. Furthermore, JD Health intends to focus on high-potential categories and launch innovative services such as AI-powered nutritionists. The company's net proceeds from recent activities will be allocated towards business expansion, including investments in retail pharmacy and online healthcare services, potential acquisitions, or strategic alliances within the next 2-36 months. The company's financial activities have been documented in various sections of the report. One notable aspect is its dividend payment history. The company has indeed paid dividends to its shareholders on multiple occasions, as mentioned on pages 40, 60, 126, and 127. However, there is no information provided regarding share buybacks. Despite references to specific pages, 26, 68, and 132, the report does not mention any instances of the company purchasing back its own shares. Concerns about inventory buildup and supply chain disruption. There are indications of potential problems in the management of inventories and supply chains. On page 122, it is noted that slow-moving merchandise and damaged goods may lead to an impairment of inventories. This suggests that companies may be holding onto inventory that is not selling well or is no longer usable. Furthermore, on page 125, it is reported that the cost of selling inventories increased by 22% in 2025 compared to the previous year. Additionally, expenses related to logistics and warehousing services also saw a significant increase. These developments raise concerns about inventory buildup and supply chain disruption, which could have far-reaching consequences for businesses and their operations. That concludes the financial summary for JD Health International Inc. Feel free to comment below, and I will be happy to answer them when possible.